Huge catalysts on the agenda for investors. We have the ECB rate decision this week and the Fed next week. Joining us to discuss is former Fed Vice Chairman and Brookings Senior Fellow Donald Kohn. Thanks for being with us today. I think I'm going to start with the ECB. The expectation, certainly investors, markets here this week are closely watching this to see whether we get some sort of stimulus package, and if so, what specifically that could look like. Your thoughts?
Well, I'm not as familiar with the ECB's tools as I am with the Federal Reserve, so I'm not sure about the specifics. But I do think that inflation is running well below their target. The economies in the Eurozone are weak overall, especially Germany and to some extent Italy. So the prediction that inflation would get back to target, I think, is not. You can't make that prediction. So I think they do need to take some action and some decisive action to move the ECB economy back towards their inflation target and to bolster growth there. I know there's an argument that maybe they ought to keep their powder dry, that something worse will happen down the road, and they've got limited scope to ease, and they need to save that scope for another occasion. But I don't agree with that. I think when you're in a situation like this, you've got to act decisively in order to head off something that's much worse, where your ammunition for sure wouldn't be adequate.
Well, what about the argument that there's a new president coming in just one meeting's time and shouldn't kind of make massive, drastic new bits of action ahead of that change in presidency?
Well, I think I don't know how much consultation there's been between the new president and the old president and the outgoing president. But I think, there's something to be said for a consultative process, for making sure that you're not doing something that she would find not acceptable. But I do think there's some action is needed. Maybe you don't need to use it all.Maybe you need to save some for her to consult with her governing council. But I do think you're putting it off, and putting it off is not a favor to the incoming chair, the incoming head, and it's not a favor to the citizens of that work in the European Union, in the Eurozone.
Looking ahead to next week and the FOMC meeting there, it would seem like, at least based on market expectations right now, a foregone conclusion that the Fed's going to cut. Do you, agree with that expectation? And if so, by how much? Is it the beginning of maybe potentially more stimulus versus this idea of a mid-cycle move?
So I agree with the general market expectations that the Federal Reserve will cut their target interest rate another 25 basis points at the upcoming meeting. I think they have ample reason to do that. The U.S. economy is fine. It's growing around 2%, has been growing around 2% for the past about year. The unemployment rate is low, 3.75%, but there are downside risks there from the trade war and the global slowdown. And inflation is running a bit below their target. Some of the more recent data have seen a bit of a pickup, but it's still running below their target. So I think buying a bit more insurance is the right thing to do at this meeting. What I'm not so sure about is where they will be going after that. So I think being on alert for another possible, on a sort of an easing bias, is the right thing to do. The downside risks, the low inflation. But after they reduce in September, they'll already be pretty substantially below where they thought, at least in June, the neutral rate was. They had the neutral rate between 2.5 and 3. They'll be between 2 3/4 and 3. They'll be between 1 3/4 and 2 after September. So they've already got a percentage point in there. You do have some pickup in inflation. The economy's doing fine. So I think I'd be looking to see whether the incoming data suggested that the economy was not inflation was not going to pick up and the economy was going to be slower than I expected. But I'm much less certain than the market seems to be that we need a whole bunch of decreases here.
Some Fed officials, Donald, have acknowledged that general outlook about the economic situation, but have said that because of the way the yield curve is set up and, of course, global yields, the fact that the short end of our Treasury market is so high in yield relative to the rest of the world suggests that it's not making an economic call to maybe cut a couple of more times just to bring that in line. What do you think?
So I think every country's interest rate needs to be attuned to what's going on in that country, taking account of what's going on in the rest of the world. But I don't think you can drive your monetary policy based on what the ECB is doing, or the Bank of Japan, or the People's Bank of China, for that matter. So I think you need to know what they're doing, but just because they're easing and their interest rates are lower doesn't mean your interest rates should be lower. You've got to figure out the effect of what they're doing and the effect of their economies on your economy, but there's certainly no automatic adjustment of our interest rates to theirs. That's why we have flexible exchange rates, so that monetary policies can be keyed to the domestic needs of each economy.
Don, where did you stand on Bill Dudley's op-ed?
I thought it was wrong and harmful. I thought it was wrong because Congress has given the Federal Reserve a mandate, a dual mandate for maximum employment, stable prices. They have given the Federal Reserve some independence from short-term political pressure to pursue that mandate, and the Fed needs to keep away from politics. They need to apply the best economic analysis possible to achieve legislative mandates. That's what Jay Powell's been saying, and I completely agree with him, and stay at and lean against whatever else might be affecting the economy, whatever the source that might be driving the economy away from the dual mandate objectives. They need to lean against it and pursue those. That's what Congress told them to do. That's what they should do. And I think it's harmful, was harmful to the Federal Reserve, because I think it fed suspicions that the Federal Reserve, say by not lowering interest rates enough now, might be motivated by political things. And similarly, say by lowering interest rates, you saw some of this in a Wall Street Journal editorial a couple days ago, that throwing doubt on what they did during the Obama administration. So I think if anything, if there were suspicions out there that the Federal Reserve was shaping its policy to influence elections, it would lose its independence. I think it was a very dangerous thing to do.